Welcome, viewers, to another episode of Route 139. We're in a process and a journey of self awareness, facing challenges, seeking many solutions, and finding our potential. Today, we have our returning guest, Mr. Steve Shalaby, president of Streamline Financial Corporation. He's a financial broker, he's a real estate agent and broker, and he is one of the best financial advisors and consultants that there is, not only in the Coptic community, in every community. So, welcome again, Steve.
Thank you, Marilyn. Thanks so much for having me.
Well, today we have a very important topic, something, well, it is the American dream. I remember when my family first came many years ago, and and it was a very small Coptic community. And my father said that he wants to buy a house, and everybody said, "Oh, why? That this is a big risk." Well, all those same people also bought their homes as well too. So, and as we became adults and finished our, graduate studies and so on, and got married, settled down, bought a house. I remember my brother actually bought his house before he got married, because here he was, this young, single graduate, working graduate, and money was going to go somewhere. So we need to find out a little bit about that. First-time home buyers, when should we do this, and what the benefit is? Why can't we just rent forever, not have to worry about anything? Just, hello, come and fix my dishwasher. Hello, come and change this, come and change that. Why is it important to have this part of the American dream? So we have our young viewers with us, college students, maybe some graduate students, and so forth. So tune in, please, and let's hear what Steve is going to tell us about first-time home buying.
Thank you so much, Dr. Claudius. Again, thanks so much for having me on the show. It's truly a humbling pleasure to be here. But I think it's also important to take note of the phrase that you used, the American dream, and really distinguish the fact that one of the things that separates America from many other countries is the very concept of a mortgage. In Egypt, it's not a very common thing. If you were to ask somebody, you're going to buy a house, well, yeah, I'm going to buy it cash. The concept of a mortgage is non-existent in most other countries. Maybe in the West it's more predominant, but many other places it's not. If you want to buy a place, you buy it cash. So it's a very nice thing here, and it's more than a nice thing. In fact, there's a statistic that says 70% of the wealth in the United States amongst families is concentrated in the equity of their homes. So what does that mean? That means, as much as cash in the bank is important, as much as having other assets, cars and jewelry and things, the equity in your home, which is defined as the difference between the value of your home and the balance of your mortgage, that equity is considered an asset here in the United States, and it counts on your balance sheet. So when you decide, or when you try to calculate your net worth, the equity plays a huge role in it. So it's very important to buy a house for a number of reasons, and not the least of which is to be able to build that net equity later in life.
Oh, that's, very important, because you're going to need that.
Absolutely. That equity is as good as cash. You can borrow against it. When would you borrow against the equity in your house? Well, I can name a dozen reasons in 2 seconds if you want. People starting a business, people taking care of medical expenses, people helping their kids start businesses, or helping their kids go off to college. You can tap into that equity into your house that you built into it. Let's say you bought a house for $100,000, but you put $20,000 down, you have an $80,000 mortgage. You have 20% equity in your house. You can't borrow all 20% of it. Generally speaking, you can borrow up to 90% of the value of your home, sometimes higher if you're buying, but that's a different story. You can borrow a percentage of that equity to pay for unforeseen expenses.
So the VA loans are great if you've had the military experience.
But there's other ways. You don't have to go to the military to get a house with 0 down payment. There are different initiatives that are available depending on the municipality or the city that you live in. And the best way to do that is to contact the city in which you live and ask them, how can I find out?
The city in which you live, or the city that you want to buy the house in?
It's usually the same thing, but sometimes it's not correct. So the city in where you want to buy the house in, there'll usually be a department called CRA, the Community Reinvestment Agency. And the CRA will usually have programs that are funded by various sources, by the private sector, by government, and they will allow you to buy a house, and they'll give you It's often these days. In the past, it used to be free money. They would give you your down payment, whatever it is, $20,000, $30,000 a down payment. These days, it's more of a what they call a forgivable loan. It goes on as a second lien on your house, and basically you can keep the money. They give you 20, 30, 40, $50,000, whatever program you qualify for, and then as long as you don't sell the house and as long as you occupy it as your primary residence, it's what they call a forgivable loan with no payments due. When you sell the house down the road, sometimes they require payment. But there's so many different CRA type programs and different initiatives like that that you really need to speak to the city that you want to buy in to find out what programs they offer and how they work.
Okay, so give me kind of like a ballpark. If I'm a graduate now, I just graduated college and I got a job, thank God.
Congratulations.
Very good. And now I want to buy a house. Okay, what percentage of my salary should go towards a house?
Good question. The answer to that is you shouldn't worry about it
Really?
because the bank is going to worry about it.
Okay,
I
so
promise you they're going to worry about
this is
it.
all you're going to qualify for.
Correct.
So
There's a
humble-
calculation that we look at.
Yeah, so
It's called the
stay
debt to
humble.
income ratio. Yeah, well,
Okay.
they will humble you,
Yes.
whether or not you like it. So the debt to income ratio is very simple. We're going to take all of your debts that appear on your credit report. So
Okay.
things like we said in a previous episode,
Right,
we don't
right.
consider car insurance or utility bills, only the things that appear on your credit report. So your credit cards, your car payments, your mortgage payments, your student loans, the mortgage payment on the house that you intend to buy, plus taxes and insurance. All of those debts, we take them and then we add them up and we divide them into your monthly income. So if your monthly income is $1,000 a month, we're going to take your total bills, and depending on the type of loan that you apply for, if it's FHA or conventional, will determine how much house you qualify for. FHA is a little bit more forgiving because it's for the first-time home buyer. So with FHA, generally speaking, we can do deals up to 50% debt-to-income ratio. So if you have $1,000 a month in verifiable income, we can lend you a mortgage that will be dictated by that payment. 50% of your income can be relegated to that.
And now, for the homes, now you can buy a condo, you can buy a townhouse, you can buy a
Single
house
family, yeah.
in a community and so forth, or, freestanding. But this is something that came to my attention recently, and that is for the condos. Because I know a lot of young people might be looking maybe at a condo or a townhouse before they look at a house, because they might want something small or starter. And something about like you own the condo, but you don't own the property. Um, is there something that, I mean,
The
I thought
concept of
you.
owning a condo is kind of a difficult one to grasp.
Right.
There's two sides of the equation. There's some people that are huge proponents of condos because they say that you don't have to worry about anything. I don't have to mow a lawn. I have all the amenities. I have a gym. I have all these wonderful things. But then there's the other side of the equation that says, well, what do you own? You own a block of air and space. You don't own anything. And the concept gets even more convoluted when you delve into the concept of co-ops.
Right.
There's not a lot of co-ops in South Florida, but a co-op is, well, this is another subject, but you don't even own the air. With a co-op, you own a share in a corporation. So it's a very, very interesting concept. So the question of whether to buy a condo or not, I have no problems with condos. I've bought and sold condos. I think they're a great investment, especially if you're young, if you're single. It might be a way to go. Minimal responsibility in terms of upkeep and maintenance and things like that. But what you do have to consider on the mortgage side of things is to finance a condo is a very, very different experience than it is to finance a single family house. So when you finance a condo, number one, using present day lending guidelines, you're going to need a much bigger down payment, generally minimum of 10% down, and much preferably 20 or 25% down. So when you compare it to a single family house where you can get in at 3.5%,
Right. Significantly less.
it's significantly less money. These days, the people who buy condos oftentimes are second homes, snowbirds, people who really, really love the lifestyle. If it's your first house, chances are you don't have that big of a down payment. You're looking for something a little bit more cost effective.
So that's something for our young grads. Keep this in mind. As a young grad, continue to live at home. Maybe, by living at home, you can, pay off your college loans a little bit faster and start to build, your, credit history and so forth. And at the same time, if you started working, then maybe you can also purchase something to take care of your taxes so that it's not all just going somewhere else. We have very, very few minutes left, but we really want you to come back, Steve, and talk to us about many, many other financial things. And in a process of self-awareness, as we travel through Route 139, and we are learning more about ourselves, and God knows us, but finances and many other challenges, personal, psychological, emotional, everything is integrated in some way or another. So we ask you to stay tuned and to learn more about yourself and find potential for problem solving, find potential for solutions, and we look forward to seeing you real soon on another episode of Route 139.